When you walk into a building and you just turn on the faucet, you really don't spend a single second contemplating the municipal reservoirs, right?
Definitely not.
Or like the water pressure algorithms, or the miles and miles of subterranean copper piping. You just expect the water to be there.
Right, it's just expected.
And frankly, that is exactly how we treat the modern macroeconomic supply chain. We treat it as this completely invisible utility.
Yeah, it's entirely abstracted away. I mean, the broader market tends to actively ignore the monumental, just grinding physical infrastructure required to keep the consumer economy functioning.
Right.
At least, right up until the moment that infrastructure cracks.
Exactly. And when you step into the world of freight logistics right now, you realize those pipes have been under immense pressure for years. And, well, we are starting to see the fractures in real time. So welcome to The Deep Dive. I'm your host, and I'm joined today by our resident logistics expert.
Hey, everyone. Really thrilled to be here to tear into this data with you.
We have a highly specific mission today. We are unpacking a single grounding source, which is the Q1 2026 earnings conference call transcript for Knight-Swift Transportation.
Yeah, and for those of you tracking the domestic physical economy, Knight-Swift, which trades under the ticker KNX, they are the bellwether.
Oh, absolutely.
They're one of the largest freight transportation companies in North America. They operate across truckload, less than truckload, logistics, intermodal, you name it.
So when a company with that much asset density, that much network visibility speaks, they're essentially handing us a real-time diagnostic report.
Precisely. It's a health report on global trade, domestic manufacturing, and consumer demand. Their operational data precedes the broader economic indicators by months, really.
Right, which makes this so fascinating. Our goal today is to look past the surface-level financial jargon, the GAAP losses, the adjusted EPS, to uncover this massive structural transformation that is actively rewiring the North American supply chain right now.
Damn, it's a huge transformation.
It is. We are going to explore how a convergence of aggressive regulatory crackdowns, highly specific safety mandate shifts, and wild weather anomalies have combined to completely flip the freight industry upside down. We're really standing at a rare inflection point.
We really are. I mean, we've watched the trucking market grind through this brutal multi-year freight recession, which was characterized by just chronic overcapacity. But reading through this Q1 transcript, it is glaringly obvious that the market is finally turning.
And what makes this deep dive so critical for you as a listener to understand is that this turnaround, it isn't happening for the standard cyclical economic reasons we usually see.
Right. The mechanics of this current market shift are entirely unique. Normally, a freight cycle turns because demand suddenly spikes or because carriers slowly go bankrupt and capacity just naturally bleeds out of the market.
Just normal supply and demand stuff.
Exactly. But what Knight-Swift's leadership detailed on this call is a forced scarcity. It's a market turn engineered by regulatory pressure and sudden network shocks. And that creates a much more volatile landscape for shippers and ultimately the broader economy.
So let's get right into the raw data, because looking at the surface level numbers for Q1, you would assume the company was just in free fall.
Oh, yeah. On paper, it looks rough.
When you look at their unadjusted numbers, their GAAP earnings, which legally has to include every single depreciating asset, accounting charge, and legal reserve, they posted a net loss of 1 cent per diluted share.
Right.
Meaning if you spread that loss across every single outstanding piece of stock, they bled a penny a share. But even when you strip away the accounting noise and look at the adjusted EPS, they only hit 9 cents.
And to put that in perspective for you, in the first quarter of the previous year, that adjusted EPS was 28 cents. So that's a massive drop.
It's huge.
And the margin degradation is even more apparent when you look at their consolidated adjusted operating ratio, or OR, which came in at 97%.
Which is incredibly high.
Right. I mean, in a capital-intensive industry like freight, where you are constantly replacing extremely expensive tractors and trailers, an OR of 97%, meaning they're spending 97 cents just to generate a single dollar of revenue, that leaves almost zero room for error.
Razor-thin margins.
Exactly. A healthy, normalized truckload operation of this scale aims for an operating ratio in the mid-80s, targeting a mid-teens profit margin. So hitting 97% indicates acute systemic stress on the network.
But, parsing the transcript, it becomes clear pretty quickly that this 97% operating ratio is something of a mirage. It's heavily distorted by this cluster of massive, isolated anomalies that essentially just dogpiled onto a single 90-day window.
Yeah, a really unlucky quarter in some respects.
Totally. First, they absorbed an $18 million adverse arbitration ruling, which originated from a less-than-truckload claim all the way back in 2022. Right. That really highlights the brutal, long-tail legal liability in this industry. An incident happens 4 years ago, winds its way through the courts, and then suddenly punches an $18 million hole in your current quarter's P&L.
The long-tail liability is a massive factor, and it plays heavily into the insurance premiums we'll discuss a bit later. But you also had a completely separate $4 million tax reimbursement charge down in their Mexico operations.
Oh, right. I saw that.
Yeah, and that was alongside some deferred housing project business and these severe sudden escalations in diesel prices. Those are painful hits, certainly, but they're non-recurring. They don't reflect the baseline operational health of the core truckload fleet.
But the anomaly that did reflect operational reality, and arguably the real catalyst for the entire macro shift we're talking about today, was the severe winter weather in January.
Well, yes.
The weather shock.
Yeah. Adam Miller, the CEO, noted the severe weather caused an estimated $12 to $14 million net negative impact for volume and cost headwinds. Trucks were frozen, terminals were snowed in, drivers just couldn't move.
But the weather didn't just hurt the bottom line. It acted as a massive stress test for the entire national freight system. And the system failed violently.
It really did. And the severity of that shock only makes sense if you look at what the freight market looked like in December, right before the storm hit.
Set the stage for us.
So, for over 3 years, shippers have enjoyed immense pricing power because there were simply too many trucks chasing too little freight. Rates were driven down to unsustainable levels.
Right.
But over those 3 years, that relentless price pressure slowly, quietly ground the capacity down. Independent owner-operators and small fleets were parking trucks or quietly going out of business. But the market didn't really register how thin the total capacity had become because the remaining trucks were handling the existing freight just fine.
I look at it like a game of Jenga that has been going on for 3 hours.
Okay, I like that.
The tower looks totally stable from the outside. The shippers see a tall, solid structure, but they don't realize that the players have slowly removed almost every single support block from the center. The market was completely hollowed out.
Yeah, that's a great way to visualize it.
So then, January brings this severe winter freeze.
Yeah.
That weather event pulls out one critical load-bearing block, and suddenly the entire structure wobbles and the routing guides completely fracture.
The fracturing of the routing guides in January is the critical data point here. A shipper's routing guide is basically their automated sequence of backup plans.
How does that work, practically?
Well, they tender a load to Carrier A at a deeply discounted contract rate. If Carrier A is frozen in a snowbank in Chicago, the system automatically kicks the load to Carrier B for a slightly higher rate.
Right, a cascade.
Exactly. But because the overall market capacity had shrunk so drastically without anyone noticing, Carrier B, C, and D were also completely tapped out. The automated backup plans failed across the board.
And when the routing guide fails, the shipper is dumped directly into the spot market, which is this real-time, instantaneous auction for a truck.
Right.
In January, because everyone's routing guides failed simultaneously, spot rates skyrocketed overnight. The panic was palpable. Knight-Swift, because they leverage their massive scale and asset-based capacity, meaning they actually own and operate the physical tractors rather than just brokering the freight, they had to step in to provide surge solutions to help their enterprise customers recover.
Which is precisely why Knight-Swift's leadership team sounded remarkably optimistic on this earnings call, despite that 97% operating ratio.
Yeah, it seemed almost counterintuitive at first glance.
It does, but the January freeze exposed the reality that the structural oversupply of trucks is officially over. The market has reached a critical tipping point where even minor localized disruptions cause acute systemic tightness.
So the winter weather was the trigger. It pulled the Jenga block. Yeah. But the fundamental question remains. What actually hollowed out the tower in the first place? If it wasn't just organic bankruptcies, what removed the capacity? The CEO makes it incredibly clear that this is a structurally unique cycle driven by a massive, deliberate regulatory purge.
Yeah, Miller states that much of the excess capacity that flooded the market during the 2021 pandemic boom when, spot rates hit historic highs and everyone with a pulse leased a truck, a lot of that capacity may not have been operating legally or safely.
He specifically points to aggressive ongoing enforcement efforts by the Federal Motor Carrier Safety Administration, the FMCSA, and the broader Department of Transportation.
Right. They are actively targeting the foundational elements of non-compliant capacity.
What does that look like on the ground?
They're auditing and shutting down non-compliant CDL schools. They're invalidating fraudulently issued commercial driver's licenses, and they're severely cracking down on hours of service logging abuses.
This targets a very specific, highly damaging element in the freight market, the chameleon carrier.
Ah, yes, the chameleon carriers.
During the pandemic gold rush, the influx of capital attracted a lot of bad actors. A chameleon carrier essentially operates with total disregard for safety regulations just to keep their costs artificially low.
Yeah.
They overwork drivers, they ignore maintenance, they falsify logs.
And then when they get caught.
Exactly. When they inevitably get hit with massive safety violations or their insurance premiums skyrocket due to excessive crashes, they simply bankrupt that specific legal entity, paint a new name on the side of the truck, and open the exact same illicit operation the very next day under a brand new DOT number.
The economic distortion caused by these chameleon carriers really cannot be overstated. Miller notes they actively exploit vulnerable labor, paying wages well below a sustainable standard.
Right.
Because they're evading insurance, maintenance, and compliance costs, their operating floor is artificially low. They can afford to take a load of freight for $800, whereas a compliant, fully insured carrier like Knight-Swift requires $1,200 just to break even on the fuel, driver pay, and equipment amortization.
It completely breaks the math.
It does. This non-compliant capacity undercuts the entire pricing structure of the market.
Which means this cycle turning isn't just Adam Smith's invisible hand at work. It's the heavy hand of the federal government actively forcing out the lowest price capacity.
Yeah, it's highly engineered.
Now, looking at this objectively, you have the CEO of a multi-billion-dollar publicly traded trucking conglomerate praising federal regulations that conveniently eliminate his cheapest independent competitors.
Right, which raises some eyebrows.
For sure. There's an entire faction of independent owner-operators who argue that these massive, complex compliance burdens are just a form of corporate consolidation disguised as safety. They argue the massive carriers are lobbying for a regulatory moat to choke out small businesses who can't afford a dedicated back-office compliance team.
And that tension between safety regulations and market consolidation is really the defining political battle within the transportation sector right now. Small fleets do argue that the burden of compliance disproportionately impacts them.
But the data tells a specific story here.
It really does. When you look at the specific empirical data Knight-Swift presents on this call, particularly regarding their drug testing protocols, the safety argument becomes incredibly compelling.
The drug testing debate is arguably the most staggering revelation in this entire transcript. Brad Stewart, the treasurer, went deep into the hair follicle versus urinalysis discrepancy.
This part was wild.
For over a decade, Knight-Swift has voluntarily chosen to utilize hair follicle drug testing for all their drivers, entirely out of their own pocket, even though the federal government only legally recognizes a standard urinalysis test.
And the reason why is pretty shocking.
Knight-Swift's internal data shows that hair follicle testing catches roughly 14 times more positive drug users than a standard urine test.
14 times.
14.
I mean, the biology dictates the data. A standard urine test might only catch drug use from the previous 48 to 72 hours. A hair follicle test provides a historical record spanning up to 90 days.
So Knight-Swift is willingly incurring significantly higher testing costs because the financial and ethical liability of putting an impaired driver behind the wheel of an 80,000-pound vehicle is catastrophic.
Obviously. But the structural flaw in the current regulatory environment is what Stewart calls the clearinghouse loophole.
And this loophole is genuinely terrifying for anyone driving on the highway.
Oh, absolutely.
Because the Department of Health and Human Services has dragged its feet on writing the final rules to officially recognize hair testing at the federal level, Knight-Swift is legally prohibited from reporting those failed hair tests to the Federal Drug and Alcohol Clearinghouse. So a prospective driver walks into a Knight-Swift academy, takes a hair test, and fails spectacularly for hard, illicit narcotics. Knight-Swift obviously refuses to hire them. But because that failure cannot be reported to the federal database, that exact same driver can walk across the street, apply at a smaller chameleon carrier that only utilizes the federally mandated minimum urine test, pass it because they haven't used in 3 days, and immediately get behind the wheel of a semi-truck.
It creates a completely bifurcated safety environment. The massive carriers are paying to identify high-risk drivers, but the lack of federal recognition means those drivers are simply redistributed to the smaller, less regulated fleets.
Right.
Knight-Swift is actively lobbying the government just to be allowed to share the safety data they're already paying millions to collect. And this hair testing debate is just one facet of a much broader regulatory net tightening around the industry.
The transcript also highlights upcoming legislative pressures, like Leela's Law, which is designed to permanently codify the crackdown on those fraudulent CDL mills we mentioned.
Yeah, that's a big one.
There is also a massive push for stricter enforcement of English language proficiency. A driver has to be able to read highway signs, understand hazardous material placards, and communicate with first responders in an emergency.
Which seems basic, but apparently needs enforcement.
Exactly.
Yeah.
On top of all that, there is a proposed federal rule to increase minimum liability insurance requirements from $750,000 to $5 million.
When you aggregate all of these pressures, the FMCSA audits, the targeting of chameleon fleets, the invalidation of fake CDLs, the English proficiency enforcement, and the potential for a 600% increase in minimum insurance coverage, the operating costs for bottom-tier carriers are skyrocketing.
It's a perfect storm.
It is. The regulatory moat is deepening rapidly, and the supply of available compliant trucks is shrinking at an accelerating pace.
And as that capacity drains from the network, the massive retailers and manufacturers who rely on those trucks are beginning to panic.
Yeah.
Which brings us to the operational fallout of this forced scarcity, specifically looking at the dynamics of the current bid season.
Right, the bid season.
For you listening, bid season is the annual cycle where major corporations put their freight networks out to bid, asking carriers for their best price per mile to move specific volumes of freight on specific lanes over the next 12 months.
And for the last 3 years, shippers absolutely dominated these negotiations.
Right. They demanded and received deep rate cuts.
But the psychological shift detailed in this Q1 call is profound. Adam Miller noted that just 1 quarter prior, Knight-Swift was targeting low to mid-single-digit percentage rate increases on their contractual bids. It was a cautious approach to a still soft market.
Which makes sense.
But following the January weather shock and the accelerating regulatory purge, they rapidly recalibrated their entire pricing strategy. They are now actively demanding high single and low double-digit percentage rate increases.
Which is huge. In a low-margin, high-volume environment like truckload freight, demanding a 10 to 12% rate hike on a massive enterprise contract is incredibly aggressive.
Oh, it signals absolute confidence that the shipper has nowhere else to go.
It reminds me of the housing market dynamics over the last few years.
How so?
Well, imagine buyers walking into open houses for 3 years straight, demanding 20% price cuts, forcing the sellers to waive inspections, and making them pay all the closing costs.
Okay.
The sellers absorbed the abuse because the neighborhood was flooded with empty inventory.
Yeah.
But suddenly, those buyers wake up and realize city regulators just bulldozed half the houses in the neighborhood for code violations.
Oh, wow. Yeah.
The remaining sellers aren't negotiating anymore. They are raising the price 10%, take it or leave it, and the buyers are frantic, knowing they risk being left out in the cold.
That's a great parallel. And the behavioral signs of that shipper panic are highly visible in the data Knight-Swift provided. First, Miller explicitly noted that off-cycle opportunistic bids have completely vanished.
And these off-cycle bids are a classic hallmark of a soft market. Normally, if a shipper has a signed contract with a carrier at $2 a mile, they might blast out an off-cycle bid to the broader market halfway through the year just to see if a desperate, starving carrier will take it for $1.85.
Right.
It's a mechanism to constantly apply downward pressure on rates. But right now, shippers are too terrified of losing the capacity they already have to play those games. They aren't rocking the boat.
Exactly. The focus has shifted entirely from price discovery to capacity retention. Furthermore, we are seeing a significant spike in turnback bids.
What exactly is a turnback bid?
So a carrier might win a lane during the formal bid process, but by the time the freight actually needs to move a few weeks later, the spot market has accelerated so rapidly that the agreed-upon contract rate is already obsolete. So the carrier simply rejects the freight, turning it back to the shipper because they can make more money deploying that truck elsewhere.
And when incumbent carriers turn back the freight or simply fail to find drivers to service the lanes they won, the shipper is forced to issue mini bids.
Right.
These are emergency short-term auctions designed to plug the bleeding holes in their routing guides. But honestly, the absolute craziest detail from the entire earnings call regarding shipper psychology is the timing of peak season discussions.
This was wild.
The transcript notes that shippers are already initiating conversations about securing peak season demand support in the first quarter.
That is highly irregular. I mean, the retail peak season, the massive influx of inventory to stock store shelves for the holidays, is traditionally a Q3 and Q4 operational challenge.
Usually around late summer or fall, right?
Yeah. If major retailers are coming to Knight-Swift in March, begging for guaranteed truck allocations for November, it reveals a deep-seated fear that physical capacity simply will not be there when the network hits a maximum strain.
And this flight to safety heavily favors an asset-based mega carrier like Knight-Swift. Shippers are waking up to the reality that a deeply discounted contract rate from a digital broker or a small third-party logistics firm is functionally worthless if that broker cannot actually locate a physical truck to move the freight.
Exactly.
In an era of forced scarcity and regulatory purges, shippers want to partner with companies that own the metal, own the maintenance terminals, and directly employ the drivers.
That asset-heavy stability is precisely how Knight-Swift intends to march their truckload segment operating ratio back down into the mid-80s. But that exact same flight to safety has a fascinating and honestly highly disruptive ripple effect on the other side of their business.
Right.
While shippers are flocking to asset-based carriers, the middlemen of the industry are getting crushed.
Which makes the data coming out of Knight-Swift's own logistics and brokerage segment so compelling. This segment operates as a pure matchmaker. If Knight-Swift doesn't have one of their own blue trucks available in a specific market, their logistics arm takes the freight from the shipper and sells it to a third-party independent trucker, capturing a margin in the middle. But their Q1 numbers here were brutal.
Very rough.
Logistics revenue dropped 9.9% year over year, and volumes plummeted an astonishing 18.9%. Now, you might assume that's just macroeconomic weakness, but the transcript reveals this was a highly deliberate, internally engineered contraction.
Yeah, this was a choice.
Since the beginning of the year, Knight-Swift intentionally terminated relationships with 30% of their partner carriers.
They systematically purged nearly 1/3 of the independent capacity they historically relied upon to execute their brokerage volume.
Wow.
Brad Stewart justified this massive contraction by pointing directly to an unprecedented spike in sophisticated cargo theft across the industry, coupled with the troubling carrier practices exposed by the FMCSA regulatory push we discussed earlier.
Now, objectively, this move seems wildly counterintuitive. If we just spent the last 20 minutes establishing that capacity is tightening, routing guides are failing, and shippers are begging for trucks, isn't intentionally cutting 30% of your partner carriers essentially setting money on fire?
It looks that way on the surface.
How does management justify shrinking their available network right at the exact moment demand is starting to outstrip supply?
It looks counterintuitive until you analyze the margin mechanics of a brokerage in a rising spot market. This dynamic is known as a margin squeeze.
Walk us through that.
So a broker operates on a fixed contractual rate with a shipper, say, $1,000 to move a load from Atlanta to Dallas. When the market is soft, the broker pays a third-party trucker $800, pocketing a healthy $200 margin.
Easy money.
Right. But when spot rates spike rapidly, as they did after the January freeze, that third-party trucker now demands $1,100 to take the load.
So the broker is locked into the $1,000 revenue from the shipper, but has to pay $1,100 to execute the move. They take a $100 loss on every single transaction until they can manage to renegotiate the primary contract with the shipper, which can take months.
Exactly.
Wait, that's the best case.
Yeah. The worst case scenario is that the fictitious carrier simply steals a multi-million-dollar load of electronics or pharmaceuticals. Knight-Swift decided that the financial and reputational risk of tendering their enterprise customers' freight to unverified high-risk capacity was no longer tenable. So they implemented incredibly rigorous qualification standards.
The transcript details how aggressive this vetting has become.
Right.
They are rigorously checking how long a carrier has maintained active operating authority, verifying actual tractor locations via GPS tracking to assure the truck is where it claims to be.
Yeah.
And they are demanding physical copies of licenses to guarantee they know exactly who is sitting in the driver's seat. They are actively stripping away the anonymity that defines the digital spot market.
It is a textbook long-term strategic play. They are sacrificing short-term transactional volume to establish a premium, high-trust walled garden.
A walled garden in freight.
Exactly. By shrinking their network down to only rigorously verified compliant partners, they are signaling to their shippers that while Knight-Swift Logistics might command a slight premium, the freight will not end up stolen by a fictitious pickup ring, nor will it end up rolled over in a ditch driven by someone without a valid CDL. Trust is becoming the ultimate premium commodity in freight.
And while the truckload and logistics divisions are navigating these violent swings in supply, demand, weather shocks, and regulatory purges, the transcript reveals that Knight-Swift is executing a completely different, highly methodical strategy in its other segments.
Yeah, a much slower burn.
If shrinking the brokerage network is a defensive move to stop the bleeding, Knight-Swift is playing aggressive offense in their less-than-truckload, or LTL division, where they are actively building out massive physical infrastructure.
The LTL market requires a completely different operational mindset than the point-to-point truckload market. In LTL, you are aggregating dozens of smaller shipments from various customers, moving them through a complex hub-and-spoke network of local terminals and cross-docks, and line hauling them across the country before breaking them down for local delivery.
It's a very intricate dance.
It is. Knight-Swift has spent the last several years engaged in a capital-intensive mission to transform their regional LTL footprint into a comprehensive national network.
And despite the $18 million adverse claim we mentioned earlier weighing down the Q1 financials, the underlying operational momentum in their LTL segment is accelerating beautifully.
Yeah, the numbers are strong there.
Andrew Hess, the CFO, highlighted their tonnage growth. Tonnage was up 1.6% in January, accelerated to 2.6% in February, and then absolutely exploded to a 6.9% increase in March.
And the composition of that tonnage is what really matters. Adam Miller detailed a strategic shift toward acquiring heavier industrial customers.
Why does the weight matter so much?
Well, this specific freight profile drives up both the weight per shipment and the length of haul. In an LTL network, maximizing the dimensional weight on the line haul trailers is how you drive yield, especially when base rate renewals are holding steady at mid-single-digit increases.
Because Knight-Swift is actively shifting their LTL network to a national footprint, they are taking on massive fixed terminal costs. Expanding from a regional player means acquiring hundreds of new cross-dock facilities, hiring local drivers, and keeping the lights on at all these new hubs.
Right, the baseline overhead is huge.
The fixed baseline cost is enormous. The genius here is that by attracting heavier industrial freight, they push higher tonnage through that exact same fixed infrastructure footprint. I always compare the LTL strategy to building a transit system.
No, that's a good comparison.
You spend years laying down the tracks and building the stations, going from a regional to national expansion. It's expensive and painful. But once the infrastructure is there, adding more passengers, which in this case is heavier industrial freight, it costs you almost nothing extra, and your profit margins skyrocket.
It's the ultimate play on operating leverage. The cost to keep a 100-door terminal operational is relatively static, whether the terminal is running at 60% capacity or 90% capacity.
Exactly.
As they layer this new heavy industrial tonnage into their newly expanded national network, the incremental cost of handling that freight is marginal. Therefore, the vast majority of that new revenue flows directly to the bottom line.
Right.
Which is exactly why Miller expressed such confidence in driving their LTL operating ratio down into the 80s over the coming quarters.
We see a very similar cross-selling synergy happening in their intermodal segment. Despite the severe weather headwinds in January, which completely paralyzes rail networks, intermodal revenue still grew 2.7%, and their total load count jumped 8.4% in March.
Yeah, that's impressive growth given the weather.
They are actively leveraging their massive, entrenched truckload relationships to convince their enterprise shippers to convert highway freight to their intermodal rail services.
It all comes down to maximizing the yield on the assets they control and ensuring that once a shipper enters the Knight-Swift ecosystem, they never need to leave to find capacity.
Keep them in the walled garden.
Exactly. Which brings us to the final and arguably most consequential strategic maneuver discussed on this call. Everything we have analyzed today, purging bad freight, demanding high-quality drivers, prioritizing safety over volume, it all culminates in Knight-Swift's integration of their massive U.S. Express acquisition.
The strategy deployed here is completely fascinating. They are literally shrinking the company to grow its profitability. A few years ago, Knight-Swift made an industry-shaking move by acquiring U.S. Express, a massive, historically struggling truckload carrier.
Right. Nearly a $2 billion chunk of business.
This acquisition added nearly $2 billion to Knight-Swift's top-line revenue footprint. But reading through the integration updates in the transcript, Miller reveals that since closing the deal, Knight-Swift has intentionally shed a few thousand tractors from the U.S. Express fleet.
Removing a few thousand revenue-generating assets from the board is a staggering reduction in scale.
Why do that?
Well, the inherited operational foundation at U.S. Express was fundamentally broken. Miller explained that prior to the acquisition, roughly 40% of U.S. Express's total load volume was heavily dependent on digital brokers rather than direct contractual shipper relationships.
And based on everything we've discussed about the spot market, relying on brokers for 40% of your freight is a death sentence for a multi-billion-dollar enterprise.
Absolutely.
The spot market is volatile, it lacks lane density, and the margins are inherently compressed because the broker's taking a cut. You cannot build a stable, predictable yield model when almost half your trucks are essentially chasing the digital equivalent of Craigslist ads for freight.
So Knight-Swift had to initiate a total operational reset. They systematically fired the unprofitable broker freight, but more importantly, they completely overhauled the driver hiring standards at U.S. Express.
Oh, right, bringing it up to their standard.
Yes, they aligned the U.S. Express recruiting metrics with the stringent, uncompromising safety standards of the legacy Knight-Swift brands. The result of that cultural shift is remarkable. The CSA Crash Basic, which is the primary federal safety metric utilized to measure crash involvement, it improved by an astonishing 60%.
A 60% reduction in crash frequency is a monumental achievement.
Yeah.
It immediately impacts the bottom line by drastically reducing insurance liability, litigation costs, and equipment replacement expenses.
It really does.
But that kind of safety discipline comes at a severe operational cost. By radically raising the hiring standards, likely implementing that hair follicle testing standard we discussed, they disqualified a massive portion of the applicant pool. They literally couldn't find enough qualified drivers to seat the inherited fleet. Coupled with the intentional loss of the cheap broker freight, they were left with massive excess capacity, forcing them to sell off or park thousands of tractors to eliminate the lease expenses.
It is a textbook turnaround strategy. However, looking at the current macroeconomic timing, one could argue it places them in a difficult position.
Yeah, that's what I was thinking.
If, as the transcript heavily implies, we are currently entering a major freight upcycle characterized by tight capacity, fractured routing guides, and double-digit rate increases, doesn't sidelining thousands of tractors severely handicap their ability to capitalize on the impending boom?
That is the exact tension the Wall Street analysts pushed Miller on during the Q&A. You buy a massive fleet to gain market share, but you sideline the equipment right before the market turns hot.
Yeah, it's a tough sell to investors sometimes.
But Miller's rationale is rooted entirely in long-term sustainability over short-term cyclical gains. You cannot profitably capitalize on a booming freight market if your underlying insurance premiums are bankrupting you due to an elevated crash rate, or if your network density is destroyed by chasing random broker freight.
Exactly. The transcript notes that the U.S. Express operating ratio currently trails the legacy Knight-Swift brands by roughly 300 basis points.
What does that mean in real dollars?
In financial terms, that means their operating margin is a full 3% worse. In an industry where a 10% profit margin is considered highly successful, a 3% drag is an anchor weighing down the entire enterprise.
Yeah, that's huge.
The only mathematical path to closing that margin gap and achieving structural profitability is by resetting the baseline. They had to tear the house down to the studs and rebuild it on bedrock.
Yeah.
Now that the crash rates are normalized and the unprofitable freight is purged, they are perfectly positioned to organically seat those remaining trucks with high-yielding direct contractual freight as the broader market tightens.
It is a phenomenal case study in operational discipline. They were willing to shrink their top-line revenue to fundamentally fix the underlying unit economics. And as we synthesize the totality of this deep dive, it becomes abundantly clear that Knight-Swift's Q1 2026 earnings call was far more than a routine quarterly check-in.
Oh, it was a massive revelation.
It was a highly detailed roadmap of a massive, painful, and ultimately necessary supply chain cleanup.
We started by looking at an illusion, a 97% operating ratio, heavily skewed by non-recurring anomalies and a severe winter storm.
Right.
But that January freeze acted as the catalyst, exposing just how fragile and hollowed out the entire national freight network had become after 3 years of relentless price pressure. We explored the mechanics of a market turn driven not by organic demand, but by a forced regulatory purge, as the government aggressively targets non-compliant CDL mills and chameleon carriers.
And then we tracked how that forced scarcity is rippling through the current bid season, causing outright panic among major shippers who are suddenly facing double-digit rate hikes and failing routing guides. We watched Knight-Swift voluntarily amputate 30% of their brokerage capacity to build a high-trust walled garden against a rising tide of cargo theft. We analyzed their aggressive infrastructure play in the LTL space, driving massive tonnage volume through fixed terminal networks to capture pure operating leverage.
And finally, we witnessed the ruthless discipline required to shrink the U.S. express fleet by thousands of tractors to establish an uncompromising baseline of safety.
And this ultimately connects back to the reality of the consumer economy. Because why should you care? The underlying cost of moving this freight is permanently baked into the price of every single item you interact with on a daily basis.
It touches everything.
From the agricultural produce in your refrigerator, to the raw materials constructing your home, to the digital devices you order online. When the structural rules of freight change, when available capacity shrinks, and when transportation rates jump by 10% to 15%, that inflationary pressure eventually cascades through the entire economy.
Which brings us to our final lingering reality of this market shift. If the FMCSA and the broader regulatory bodies are successful in their ongoing purge, if they permanently eradicate the cheap, non-compliant capacity from the highways, and if highly accurate safety protocols like hair follicle testing become the unyielding national standard, we will, without question, have significantly safer highways.
Definitely. The reduction in catastrophic accidents will save lives.
But safety requires immense capital. As the baseline cost to operate legally, fully insured, and compliantly skyrockets, the era of bottom feeder spot rates will vanish. And as that cheap capacity disappears from the market entirely, the ultimate question becomes, how long until the era of heavily subsidized, cheap, fast, and free shipping permanently disappears from the American consumer expectation?
It is the ultimate macroeconomic trade-off. We universally demand safer infrastructure and safer roads, but the reality is that compliance carries a massive price tag, and eventually that price tag makes its way to the checkout counter.
It always does.
So the next time you turn on the faucet or click Buy Now on your phone, remember, the invisible plumbing isn't invisible anymore. The pipes are being completely rebuilt, heavily regulated and stress tested right under our feet, and the bill is finally coming due.